The U.S. dollar is going to lose its world reserve currency status, and it will. And people say, "Well, when is it going to be replaced by the yuan?" China doesn't have a free-floating currency. Well, listen, it's going to be replaced by, and it's being replaced by gold. The United States can't steal China's gold, but you know what? It makes a lot of sense. The most sense is when the government of the United States is bound and determined to reduce the interest rate on those reserves. So it doesn't make any sense to park your reserves in treasuries that are on their way yielding back to 1 or 2%. It's just not worth it when you have the currency translation and you have the risk for confiscations. So it makes much more sense to hold your money in your possession in gold.
Michael Pento says the pullback in gold and silver has people wondering if the bull market is over, but he's not buying that story. In his view, nothing fundamental has changed. This isn't the start of a breakdown. It's a normal correction inside a larger, ongoing uptrend. Every strong market breathes in and out, and this one's no different. Here's what he's watching. The Federal Reserve has quietly gone back into crisis mode. They're cutting rates again, ending quantitative tightening and expanding the balance sheet, which is just another way of saying they've turned the money printer back on. None of that points to a stronger dollar, and certainly not to the end of a precious metals rally. The U.S. is still running deficits north of $1.8 trillion, with debt climbing faster than GDP. That's not stability, that's structural decay. Pento says until any of that changes, gold's long-term case remains intact. Fiat currencies always end the same way, they devalue or collapse. The dollar might not disappear, but it will eventually lose its reserve status. And when that shift happens, gold, not the yuan, not the euro, and not another paper currency, will fill the void. Central banks already understand this. China, Russia, and even some Western nations are quietly diversifying out of U.S. treasuries and into physical gold. They're not chasing yield anymore, they're seeking safety from a system built on debt and political risk. That's the real story behind gold's strength, not short-term price swings, but a global revaluation of what money actually means. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
You have to evaluate, is this a trenchant watershed moment, epiphany in the precious metals market? Is the bull market over, or is it just a healthy pullback? And nobody knows for sure at this moment. God only knows, and I'm certainly not him. But I will tell you this, what has really changed? And the answer is nothing. We had a secular bull market in precious metals that went vertical. It just went linear. And in my opinion, at this juncture, this moment, it's a healthy, necessary pullback in the bull market of precious metals. Because look, I mean, here's the facts. The Fed is panicking now. They're actually in panic mode. They're not panicking to raise interest rates. They're now going to actually accelerate the monetary debasement of the dollar because they're cutting interest rates. They're going to cut again next week, second time. This is before the new chair comes in May of 2026, who's going to cut rates even more aggressively. The Fed is ending quantitative tightening. As a matter of fact, I checked yesterday, I looked at the Fed's balance sheet. Quantitative tightening means you're actually shedding assets, so you're draining the balance sheet. The opposite is, since October 1st, the Fed's balance sheet has been increasing. So they're already in the process of quantitative easing. And I think that accelerates under the new Fed chair it coming in 26. And then is China now selling gold to stockpile treasuries? Is Russia doing that? So, I mean, so there's nothing really changed. Has the United States paid off its debt or deficits? The deficit this year is the same as it was last year, despite all the revenue that we're taking in tariffs. It's the same number, $1.8 trillion. That's not my opinion. That's a fact. So, from the Congressional Budget Office. So, deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So, until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction. China dumping their gold reserves, or Russia dumping their gold reserves. This is some kind, weak hands that said, listen, I'm up 100% in my precious metals miners, and I need to sell because I'm kind of panicked because they're down a little bit today. But in the long run, listen, I've been in this business for 30, how many years have I been in the business for? 35 years almost now. I remember decade after decade where gold was hated. It was derided. Nobody owned any gold. We're just seeing the incipient inclusion of gold as a genuine ballast to your equity and bond sleeve. It's a genuine offset to occurrences that would make bond prices go down and stock prices go down. It's a genuine ballast in your portfolio, and it's a necessary sleeve in anybody's portfolio. It's been that way for me for decades, but now it's finally being embraced incrementally and on the margins by Wall Street. It's still nothing compared to what I think how much they're pushing cryptocurrencies. It's still, you know why? Because gold is the great revealer. Done again. It makes governments and Wall Street look like fools. It unwraps the folly of government and big banks. That's why they hate it so much. Every fiat currency that's ever existed has gone to zero. So I don't think there's going to be anything different about the U.S. dollar. But at least, if you don't believe that, the very least you can say is that the U.S. dollar is going to lose its world reserve currency status, and it will. And people say, "Well, when is it going to be replaced by the yuan?" China doesn't have a free floating currency. Well, listen, it's going to be replaced by, and it's being replaced by gold, because gold is not. If China sells us excess goods, and they have a currency surplus, and they used to want to park it in treasuries, which are backed in dollars, and those treasuries and dollars are now subject to tariffs and confiscations, and they say, well, wait a second, I'll just take my surplus and buy gold, and I will hold it myself. And that makes a lot of sense. It always makes some sense, because the United States can't steal China's gold. But you know what? It makes a lot of sense. The most sense is when the government of the United States is bound and determined to reduce the interest rate on those reserves. So it doesn't make any sense to park your reserves in treasuries that are on their way yielding back to 1 or 2%. It's just not worth it when you have the currency translation and you have the risk for confiscations. So it makes much more sense to hold your money in your possession in gold. And I don't think that's changed. I don't think that rationale has been disabused.
Michael Pento argues that inflation is accelerating again, despite official numbers being distorted by adjustments. He watches not just inflation itself, but its rate of change, and that rate is climbing. While inflation rises, the Federal Reserve is panicking in the opposite direction, cutting rates, ending quantitative tightening, and quietly restarting quantitative easing. The Fed's balance sheet, which was $700 billion before 2008 and peaked near $9 trillion, is growing again. Meanwhile, the reverse repo facility, once holding $2.5 trillion in excess reserves, has been drained to nearly zero. He says this puts the U.S. on the verge of another repo or liquidity crisis, and the Fed is acting preemptively by flooding the system with more liquidity. But adding liquidity into an already inflated system only deepens the long-term problem. With inflation above target for over 4 years, housing and stock markets in bubbles, and talk of new stimulus coins, he believes the U.S. is heading toward stagflation and a bond market crisis. Once inflation and insolvency collide, panic will hit the Treasury market. At that point, he warns, the only rational move will be to short the market, hold cash, and buy gold and silver, because no amount of money printing can fix what's coming. Let's get back to the interview.
Well, I mean, I don't have a number for you. I just know it's much higher than the hedonically and substitutionally adjusted. I mean, who cares? Does anybody invest looking at the CPI? I look at the rate of change of things. Actually, the second derivative is the most important thing to me. So it's the rate of change or the rate of change. And for me, it means that inflation is heading higher at a faster rate. So we're growing at 2.7% year over year now. This next print, whenever we get it, because the government's closed, but we're going to get a print on Friday. And I think it's going to be 3.1%. That's higher than 2.7. So the rate of change is accelerating. And yet we see the Fed, for some unknown reason, is anxious and now panicked to cut interest rates, end QT, and re-enter QE. Even though we spent 4.5 years above their silly, ridiculous, derisive target of 2%, and we're 50% above 2%, heading further away from 2%, and they're cutting interest. The reverse repo facility. This is basically the excess reserves from banks that they didn't need, and they parked it at the Fed. And that was used to buy treasuries to make sure we had quiescence in our bond market, even though we're an insolvent nation. That was $2.5 trillion in 2022. Well, today it's effectively zero. So the Fed knows that all of that excess liquidity that the banks had parked at the Fed is now gone. So they don't want another repo crisis like they had in 2019. We're on the the threshold, the doorstep of another one. So they're preemptively, obviating the need for that aggressive rate cutting and to, spike the balance sheet by $1 trillion. They're trying to get ahead of that by now ending QT, lowering interest rates, and rebuilding the balance sheet. It's funny that the balance sheet was $700 billion prior to the global financial crisis. It spiked to $9 trillion. They managed to get it down all the way to $6.3 trillion. From $700 billion to $6.3 trillion. And the reserves in the system were almost negligible, almost zero. And they spiked through. As a matter of fact, I'm going to put on my web, as part of my midweek reality check this week, I'm going to put a chart up of reserves in the financial system and show how they spiked from like zero to over $3 trillion since the global financial crisis, and then really went ballistic after COVID. And there's still, a superfluous amount of reserves in the system, and yet they're adding those reserves. So you want to understand why people are pining for an alternative to the U.S. dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver, and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks from now. So inflation's been above the Fed's target for 4.5 years. We've got record asset prices in stocks. We have a huge, tremendous housing bubble, a massive bubble in credit. And yet the Fed is preparing to dump, helicopter money along with the Treasury. In fact, the Treasury is talking about, along with the administration, another round of helicopter money, another stimulus check for $2,000 worth of, America coin, whatever, in cryptocurrencies. This is lunacy beyond belief. And of course, people are looking and seeking shelter in precious metals, and they should, because we are an insolvent nation. And the only thing that's going to, I will say this, the only thing that's going to end this bubble is going to be a combination of, yes, we are insolvent, we know that, but you need also insolvency and inflation to run intractable. I think that's what's going to occur. We're going to set ourselves up for intractable and protracted stagflation, which is going to lead to a bond market crisis. So in other words, you're going to have panic selling in the Treasury complex, not just because of a repo crisis, because there's no liquidity, because they're going to supply liquidity, as we just talked about. But then the liquidity is coming on top of an inflation problem, and you can't solve an inflation problem by creating more inflation. So there's a very high probability that you're going to see a bond market crisis that is not engendered by liquidity, but engendered by insolvency and inflation. And then that's the cue for me to get the heck out of harm's way. I mean, just go and short the market, go into cash, go into T-bills, and go in and short the market. Because there's nothing the government can do. Dunnigan, what does the government do when there's a crisis? In the past, this nation has done two things. They've printed a ton of money And the Fed has monetized that money to send to people, send to banks or send directly to individuals. But when your problem is already inflation, you're only going to exacerbate that inflationary problem.
The pattern is clear. Every time policymakers try to escape the consequences of past excess, they end up digging a deeper hole. Michael Pento's warning isn't about short-term volatility, it's about a system that's running out of exits. The U.S. economy is trapped between inflation that won't die and debt that can't be repaid. Each new dose of stimulus buys time but erodes credibility. And while the Fed may dress its actions in technical language, the outcome is the same: more liquidity chasing fewer real assets. In that environment, gold and silver aren't just hedges, they're escape valves from a monetary experiment nearing its limits. The truth is, this pullback isn't weakness, it's noise inside a structural shift. The growing demand from central banks, the quiet retreat from treasuries, and the slow decay of dollar dominance all point in one direction. Confidence is fading. The real story isn't in the price ticks but in the policy desperation. When a financial system starts recycling its own mistakes, history shows what comes next: a reset, not a recovery. The real question is whether investors will spot that shift before it becomes obvious, or only after the world's money printer finally runs out of ink. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.